Welcome to the Deep Dive, the show that cuts through the noise to bring you the essential insights you need to be truly well-informed. Think about your day for a second. Tapping your card for coffee, maybe paying a bill online later, splitting dinner with friends through an app. Digital payments, well, they're just everywhere, aren't they? And quietly, behind the scenes, a handful of global companies underpin so much of that daily commerce. Today, we're pulling back the curtain on one of those giants, Mastercard. Our mission in this deep dive is pretty straightforward. We're going to unpack their most recent 10K annual report for 2024. We'll extract the most important nuggets of knowledge and insight, give you a shortcut to understanding Mastercard's business, their financial health, how they create shareholder value, and their outlook moving forward. It's a rapidly evolving landscape out there. So we've set the stage. But to really get a grip on Mastercard's strength, we have to look at the scoreboard, right? What do their latest financials tell us about their performance last year? Let's unpack this, diving straight into the numbers.
Mastercard had, well, quite a compelling year in 2024. Really robust growth across key metrics. Looking at their GAAP, that's generally accepted accounting principles performance, net revenue hit $28.2 billion. That's up 12% over the prior year. Net income climbed to $12.9 billion, a 15% increase. And diluted earnings per share, EPS, saw an even stronger jump, reaching $13.89. That's up 17%. Pretty solid.
Yeah, solid is right. And what's fascinating here is how those numbers look, well, even stronger when we consider the non-GAAP currency-neutral figures. GAAP gives us that standard audited view, but non-GAAP numbers, they sort of peel back layers like currency swings or certain one-off items. It gives a clearer picture of the underlying business performance. And on that adjusted basis, net revenue was also $28.2 billion, but the currency-neutral growth was slightly higher, 13%. Adjusted net income rose to $13.5 billion, up an impressive 18%, and adjusted diluted EPS was $14.60. It's a 21% increase. This consistency, this double-digit growth, especially currency neutral, it really signals strong underlying business momentum and makes you ask, doesn't it? What were the fundamental drivers behind these impressive numbers beyond just general market trends?
That's exactly what I was wondering too. Beyond just the top line, how efficient are they? How financially robust? The report shows Mastercard generated a substantial $14.8 billion in net cash flows from operations. That's a lot of cash. Their adjusted operating margin also ticked up, hitting 58.4%. That's up 0.7 percentage points, currency neutral. I mean, that's a huge margin for any company. It really indicates strong profitability from their core operations. And what's particularly striking, I thought, was their effective income tax rate. It actually decreased by 2.3 percentage points to 16.2% on a non-GAAP basis. Now, this was mainly due to a valuation allowance back in 2023, being able to claim more U.S. foreign tax credits, and a favorable change in the geographic mix of where their earnings came from in 2024. And there's a specific detail worth noting, a big incentive grant from the Singapore Ministry of Finance. That alone reduced their effective income tax rate by about 4% in 2024. So when you put all these figures together, you're seeing a company that's not just growing revenue, but it's also getting more efficient, generating tons of cash, and, well, strategically managing its taxes.
It all contributes to its overall strength and that positive growth path.
Exactly. The consistent growth, the robust cash flow, those impressive operating margins, they all point to a really resilient business model. And that tax rate adjustment, especially the Singapore grant you mentioned, it highlights how these huge global companies actively manage their financial footprint, using strategic incentives. It directly hits their bottom line and frees up capital for reinvestment or shareholder returns. It's a key part of optimizing their financial health.
Okay, so the numbers paint a clear picture of growth. But how is Mastercard actually doing this? What's the strategy? The 10K lays out a pretty fascinating roadmap built on 3 core pillars designed to fuel that future growth. First, they're intensely focused on growing the core. This is all about consumer payments. Their goal here seems to be enabling consumer choice and flexibility across lots of different payment rails, so traditional cards, but also real-time payments, account-based transactions, things like that. This involves trying to capture that big opportunity of cash displacement, pushing technology and partnering across the payments ecosystem. And importantly, they're opening up closed loop and domestic networks.
Right, like store cards or local debit systems.
Exactly. Systems where maybe one entity handled both sides. They're trying to bring those transactions onto Mastercard's bigger, more efficient network. Plus, they're extending their reach into areas that maybe weren't fully penetrated before, like bill pay and real-time account-based payments.
And that leads straight into their second priority, diversifying customers and geographies. This is where they're really trying to capture opportunities in commercial payments. We're talking both at the point of sale, the POS, and for invoice payments, and also that huge market for disbursements and remittances. For commercial POS, they're offering like differentiated things, corporate cards, small business solutions, expense management tools, data insights, while pushing distribution globally. In the commercial invoice payment space, that's more complex B2B stuff. They're driving engagement between buyers and suppliers to simplify workflows, free up working capital, improve data matching. They're expanding into new verticals too, like B2B marketplaces, healthcare, pharmaceuticals, embedding payments right into the platforms businesses already use. And then for disbursements and remittances, they're using Mastercard Move. That's their platform to scale use cases like B2C payouts, paying gig workers, insurance claims, expanding how money moves globally, whether it's to bank accounts, mobile wallets, cards, or even cash pickup. The sheer scope is pretty impressive.
It really is. And their third priority, building new areas for the future, that's all about their services and other solutions. This means offering this expansive, diversified portfolio built on their own data, unique payment capabilities, and just driving value beyond the transaction itself. Key service areas here include robust security solutions fighting fraud, cyber attacks across card and non-card payments. Super important today. They also offer consumer acquisition and engagement services, think marketing, loyalty programs, plus business and market insights, economic data, location insights, payments consulting, operational stuff. And beyond that, they have other solutions, like an open banking platform for secure data access, lending tools, account opening services, and secure account-to-account payments.
Right. And if we connect this all back to the bigger picture, you really see this deliberate multi-rail strategy taking shape, expanding way beyond traditional cards, capturing more of that whole money movement landscape. It's not just diversifying for the sake of it, though. It's about positioning Mastercard to be the kind of indispensable orchestrator for all types of payments, no matter the underlying rails. And their services segment, especially, is deeply tied into their payment network. It drives value for customers with insights and security, sure, but it also generates significant high-margin revenue for Mastercard itself. This multi-pronged approach, it's really designed to keep them at the forefront, in this rapidly evolving payments world, making sure they capture every possible flow of money, not just card swipes.
It makes sense. It's not just what they're doing, but how they're doing it, like you said. Mastercard highlights several core capabilities that underpin this whole strategy. First up is their technology. They really emphasize resilience, scalability, flexibility, and a big move toward cloud-native infrastructure. They're continuously investing in new tech AI, blockchain not just for a competitive edge, but to deliver seamless services and empower their own people, which ties directly into their focus on data and AI. Mastercard uses all sorts of data assets, transaction data, digital identities, threat assessments combined with AI, machine learning, even generative AI to make commerce smarter and safer. And crucially, they highlight their data and tech responsibility principles. A strong emphasis on privacy by design, building privacy and security controls in from the ground up.
Absolutely. That's becoming increasingly critical. And their brand is, well, it's a massive global asset. Names like Mastercard, Maestro, Cirrus, plus that iconic priceless campaign, it all builds visibility, usage, trust. Underlying all of this is their franchise operating that four-party payments network. You've got the cardholder, the merchant, their banks, and Mastercard facilitating it all. It creates this balanced ecosystem where everyone benefits from availability, innovation, safety, security. It's a complex, self-reinforcing system, incredibly hard to replicate.
They also really emphasize their talent and culture. It's guided by the Mastercard way, which has these three principles: create value, grow together, and move fast. It seems like a big focus on attracting and keeping top talent, developing a high-performing workforce, offering competitive pay, as they contribute, $1.67 for every dollar an employee puts into their 401k on the first 6% of pay.
Yeah, that's quite generous. Shows commit.
Right. And they offer well-being programs, flexibility policies like a 4-week work from elsewhere option.
Right.
It's all about fostering a strong ethical culture. And finally, their commitment to doing well by doing good. Their sustainable impact strategy, using employees, tech, partnerships to tackle social, economic, environmental challenges while still aiming to drive long-term shareholder value.
What's really fascinating here is how all these capabilities reinforce each other, isn't it? The tech enables the data and AI, which enhances the services, and it's all built on that strong global brand supported by an innovative ethical culture. These interconnected pieces are absolutely crucial for them to innovate and compete effectively. You could even argue that their focus on talent and that privacy by design approach give them the significant edge as regulations around data and AI get tighter everywhere.
Yeah, that's a good point. But of course, no deep dive is complete without looking at the challenges. And the payments industry is incredibly dynamic.
Yeah.
Mastercard faces some significant headwinds. First, the competitive landscape. It's just intensifying dramatically. They're seeing way more competition from agile new fintechs, digital wallets, buy now, pay later services, mobile operators, specialized B2B payment providers. These new players often focus on online and mobile, sometimes processing payments using their own internal transfers or real-time networks, not just traditional cards.
Right. And beyond the private sector competition, there's also the rapid growth of government-backed solutions. We're seeing more digital public infrastructure, DPI, and central bank digital currencies, CBDCs, popping up as alternatives. Think about Brazil's PIX, FedNow in the US, India's UPI. These are increasingly seen as viable alternatives, especially for domestic payments. They could potentially chip away at Mastercard's transaction volume. And let's not forget the traditional competitors. Some have deeper pockets or run three-party systems that might face less regulatory heat, giving them an edge in certain markets.
And speaking of regulatory heat, the regulatory and legal risks front looks pretty challenging. Mastercard faces ongoing battles over interchange fees globally. Lots of legislative and legal efforts trying to push those fees down. If those fees, which are, core to their revenue, get reduced significantly, it could make their products less attractive or just cut transaction volumes. There are also limits on their ability to stop merchants from surcharging, which could put consumers off using cards. And then all the evolving rules around privacy, data, AI, like the EU AI Act, the US CFPB data rule, they add huge compliance costs and could restrict how they use data for innovation. In 2024 alone, they booked massive pre-tax litigation provisions, $680 million, mostly for a UK consumer class action settlement, UK merchant settlements, and adjusting estimates for US merchant litigation. Plus, they had a $190 million restructuring charge. And this is on top of ongoing legal fights, the Australian ACC complaint on debit programs, the Telephone Consumer Protection Act class action, investigations by the US DOJ and the European Commission. Wow.
It seems like legal challenges are just a constant cost of doing business at that scale, doesn't it?
It really is.
And that ties right into the operational and market risks. Despite having robust security, the risk of data breaches, cyber attacks, it's always there. That can lead to huge reputational damage, legal claims. Plus, a significant chunk of their revenue comes from just their 5 largest customers. That's a concentration risk. Losing even one could be a major blow. There's intense pricing pressure from customers and competitors, forcing them to offer more incentives, bigger discounts, which obviously hits margins. And then there's that subtle risk of brand invisibility you touched on earlier.
Right, with digital wallets and embedded payments.
Exactly. The Mastercard logo might be less visible. It's not just about looks. It means they have to prove their value differently, focusing on reliability, innovation behind the scenes, not just brand recognition at the till. And finally, strategic acquisitions, while good, can bring new regulatory headaches and security vulnerabilities. Like the Recorded Future acquisition in 2024, great for cybersecurity capabilities, but integrating it safely and complying with regulations is another challenge. It really raises the question. In this kind of dynamic, often adversarial environment, how does Mastercard keep driving value and innovating with all these pressures coming at them?
That is the critical question. So what does this all mean for you, the listener, whether you're an investor or just interested in how big companies manage their money? Well, Mastercard is clearly focused on creating shareholder value. In 2024, they returned a massive $13.4 billion directly to stockholders. This was mostly through share repurchases. They bought back 23 million shares for $11 billion. And this follows big repurchase programs approved in 2023 as well, $12 billion and $11 billion. So it signals a really consistent commitment to reducing the share count, boosting EPS.
Definitely. And on top of the buybacks, they paid out $2.4 billion in dividends in 2024. That's a direct cash return to shareholders. But it's not just about returning capital now, is it? It's also about investing strategically for future value. In 2024, they spent $2.8 billion in cash acquiring businesses. The biggest chunk of that was Recorded Future, bought for $2.7 billion in December 2024. And that acquisition isn't just a big number. It's expected to add really critical threat intelligence capabilities to Mastercard's identity, fraud prevention, real-time decisioning, cybersecurity services, all areas absolutely vital for secure digital commerce going forward.
Yeah, if we connect that to the bigger picture, like you said, these actions show a clear commitment to both things. Direct returns now, through buybacks and dividends, and strategic long-term investments. Investments that strengthen their core business and those future growth areas, especially in hot segments like cybersecurity and data intelligence. It looks like a balanced approach to capital allocation, rewarding current shareholders while positioning the company for continued innovation and growth, especially maybe in response to some of those risks we just talked about.
Seems that way.
So wrapping this up, what does it all mean as we look to the horizon for Mastercard? What's the overall assessment here? Several key takeaways really stand out from this deep dive, I think. First, Mastercard is definitely pursuing that multi-rail strategy actively, expanding way beyond just cards, trying to capture more of the total money movement landscape. Second, there's that heavy strategic investment in technology, data, and AI. It's clearly central to how they plan to differentiate themselves and what they'll offer in an increasingly digital world.
It's also clear that those talent and culture initiatives are seen as critical to their business strategy. Human capital as a core strength, really. However, they are at the same time navigating a really complex and, frankly, increasingly scrutinized regulatory and legal environment. We talked about the big litigation provisions, the evolving data and AI laws. It demands constant adaptation and compliance. It'll be fascinating to see how they handle those external pressures while trying to innovate internally.
Indeed. But despite all those competitive pressures and regulatory headwinds, Mastercard's strong 2024 financial performance, plus the big capital returns, plus strategic acquisitions like Recorded Future, it all points to a pretty resilient business model. They seem clearly focused on long-term value creation, not just, short-term wins.
Yeah, I'd agree. Mastercard's ability to thrive going forward really hinges on its adaptability and continuing to invest in those core capabilities, especially multi-rail tech and enhanced services. How they respond to competitive threats and regulatory changes will be absolutely key, but their foundation does look strong. And maybe here's a final thought for you, the listener, to mull over. As regulation around data, privacy, and AI continues to increase, how might that fundamentally reshape the competitive playing field? And will companies like Mastercard, with their established focus on privacy by design and, let's face it, deep experience dealing with regulators, actually be better positioned for this future than some of their newer, maybe more agile competitors who might have prioritized speed over compliance up to now? Something to think about.
That is definitely something to think about, a lot to consider. We hope this deep dive has given you a clearer understanding of Mastercard's current performance and where they might be headed. We encourage you to keep exploring how these trends in payments might impact your own financial life or your industry. Thanks for joining us for this deep dive.